Today, we will discuss macro investing in the age of AI, how to build smarter portfolios with Giannone.
One of the reasons that drove me to be so interested in this and to join Allio was that when you look out there at the options for investors to build portfolios, to grow wealth through time and to protect capital and to manage risk, there really aren't too many great solutions. And the solutions that are out there haven't really been improved upon. How can we repackage and resell this? Really our core mission and our core goal is to build Allio into something that can give people a better chance at realizing better financial outcome for them.
Could you discuss the key issues in your industry?
I think you end up in a scenario with a lot of people where they're really unsure where to turn. A lot of them will go and ask people in their network, hey, do you have a financial advisor or do you use a robo-advisor? And it's really just there's not really a systematic way to do that. And it results in a lot of people ending up in situations that aren't really necessarily the best for them personally. And these situations could be they're paying too high fees, they're being put into things that aren't necessarily custom tailored for their goals and objectives, or simply they're just being ignored by their financial advisor because they don't have enough money and they aren't a high net worth individual or whatever.
Hello everyone. Thank you for joining today's Innovator Circle podcast. I'm your host, Dr. CFA, CEO of Time Research and Innovations in the marketing agency and 𝐏𝐫𝐞𝐦𝐢𝐞. ICPcast is an initiative to bring innovative ideas, transformative strategies, and forward-thinking insights from various industries, whether it is in technology, artificial intelligence, marketing, finance, lead generation and sales, business advisory and development, tax and accounting, or sustainability. We all covered. We bring you insights from some of the brightest minds, C-level executives, and industry leaders who are shaping the future. In today's episode, we have a very special guest, Giannone, FCA Chief Investment Officer at Allio Capital. AJ leads the development of next investment strategies grounded in macroeconomics, insight, and driven by cutting-edge technology. With over a decade of experience in portfolio management and a background that spans institutional finance and fintech innovation, AJ is helping reshape how modern investors think about wealth and risk. Prior to joining Allio, he held leadership and portfolio roles in Eldon Investment Group, Forefront Analytics, and Bluestone Capital Management. His work blends deep macro analysis, covering geopolitical, fiscal, and monetary trends, with advanced digital tools that makes intelligent investment more accessible. Today, we will discuss macro investing in the age of AI, how to build smarter portfolios with Giannone. So, to all our viewers, get ready for practical strategies, insightful discussion, and fresh ideas to help you grow success. Hello, AJ. Good afternoon. How are you?
Hi there. I'm doing well. Looking forward to having a great conversation today. Thanks for having me.
Thank you very much. Welcome to Innovator Circle podcast, and thank you for joining me. As you know, that this podcast is designed to get every detail that tailored to have a great results in your company or supporting other people. So we have a set of questionnaires that we're going to be asking, and we wanted to dive into deeper every levels that we could be. So the first thing that I wanted to ask you, could you please provide a brief overview of your business and share what inspired you to enter to this field?
Sure. Allio Capital is a next generation wealth and robo-advisory platform that is designed to really offer investors a better way to build and compound wealth and realize their financial goals over time. And given what we've seen in the markets, over the last 2 decades, you've seen the dot-com bubble, the financial crisis, sovereign debt crises across Europe and FX issues in Asia. There's all these compounding macroeconomic issues that are out there. And Allio's core belief, and a belief that I share, and really one of the reasons that drove me to be so interested in this and to join Allio, was that when you look out there at the options for investors to build portfolios, to grow wealth through time and to protect capital and to manage risk, there really aren't too many great solutions. And the solutions that are out there haven't really been improved upon in the last 50 to 60 years. You had the Markowitz mean variance portfolio theory that won a Nobel Prize going back to, as early as the 50s. But really since then, everything's just been an iteration of, how can we repackage and resell this in a way that, frankly, to most investors has just resulted in higher turnover and higher fees and things like that. So, really our core mission and our core goal is to build Allio into something that can give people a better chance at realizing, a better financial outcome for themselves. So, we utilize a whole bunch of really interesting tools. We've leveraged all the experience that our team has assembled collectively over the last, 10 or 15 years. And we think we've got something that's really compelling, and we're really excited to talk to you about today.
Thank you very much, AJ. We're going to be covering more deep dive into the finance today. So to everyone, if you're watching this podcast, please feel free to share this with your network. They might feel interested, and the way we're going to be talking today, it might come handy for some of your friends or family or even business partners to talk about microfinances. So my next question to you, could you discuss the key issues in your industry and explain how your efforts are making a difference for your clients and your collaborators?
Sure. So, fundamentally, there are a bunch of different ways that folks can kind of solve the problem that they have of, hey, how do I invest? How do I grow wealth? How do I manage risk? And how do I protect my cap? And I think you end up in a scenario with a lot of people where they're really unsure where to turn. A lot of them will go and ask, people in their network, hey, do you have a financial advisor, or do you use a robo advisor? And it's really just there's not really a systematic way to do that. And it results in a lot of people ending up in situations that aren't really necessarily the best for them personally. And these situations could be they're paying, too high fees. They're, being put into things that aren't necessarily custom tailored for their goals and objectives, or, simply they're just being ignored by their financial advisor because they don't have enough money and, they aren't a high net worth individual or whatever. So, when you look out across the landscape of solutions and options that people have in this space, you have your high priced wealth advisors, you have your more reasonably priced robo advisors, but fundamentally both of those solutions often use the same style of portfolios, and it's the same type of portfolio, that you'd find in a textbook that was written in, 1965. It is relatively static. It's not really designed or intended to be adaptive to current market environments. It's not terribly effective at mitigating risk or protecting against drawdowns. And so, that's really the issue that we see out there, is that, investors are really being let down and underserved in the market. And, that really is a shame, because most folks, similar to the way you manage your taxes, go find an accountant and you trust that person, is acting in your best interest. In a lot of cases, folks aren't really equipped or capable or willing to do the work to understand if they are being served or if their best interests are being addressed. And our goal is to make that process more transparent, deliver better solutions at a lower cost that add value, that makes an investor feel like, wow, I've got a portfolio that's worked for me. It's both adaptive to different market environments. It can potentially, protect capital to the downside when things deteriorate in the macroeconomy. And, this is something that to me is a missing piece of the puzzle for a lot of people out there.
Thank you, AJ. It was a good explanation, I would say. So my next questions, who are the clients you aim to help, and what key benefits do you deliver to them?
We look to really help anyone with investable assets. So, if you have some money that, you put away, even if it's sitting in a checking account or a money market, but you're looking to invest, we have solutions that can be effective for both the smallest portfolios all the way up to the largest portfolios. So our minimum account size is $500 right now. That will increase at some point up to $1,000, but we are able to offer customized, reactive, AI-powered investment solutions for really any size and scope investor that's interested and finds value in what we're doing. And from the conversations that we've had, in this space, when talking with clients, when talking with prospects, there's really a huge demand and an interest for what we're doing, because similar to what we've discussed already, there's a feeling that investors have, regardless of how happy or unhappy they are with their current solution, that there should be a better way. And that's really what we're attempting to provide them. And that's kind of the conversation that we've had back and forth with the clients who've been using us so far, is how do we take what we have and iterate on that process and that solution to continue to give them that next generation wealth advice that they're so desperately craving.
Thank you, AJ. My next question, you are on the field of AI, although this question is just a connected question, it's not on my list of questions. As an AI data scientist, having a PhD on AI, the way I understand AI is different and as usual, people will understand it. So mostly that people are thinking about that AI will capture everything and then human will be great danger. So in relation with finance, as I have less understanding of finance and investment, can you elaborate in detail, like, okay, your AI system and the fear of people, how you manage those two things for the client?
It's a great question. I'm glad you brought it up because we're really proud of what we built in this regard. And the fundamental difference between what we're doing with our portfolios with respect to AI and what a lot of other companies are doing with respect to AI is, they're using the standard, ChatGPT or large language model wrapper, where they're basically just, using RAG or some sort of like, hey, here's our data. You can ask it a question and it'll spit out an answer. And it's very language oriented. What we're doing is attempting to use AI in a different way entirely. And we are, going down that path of like, hey, how do we, build a chat bot at some point? Everyone's got to have a chat bot now. So that's obviously on the roadmap. But when you look at the investment management industry in particular, the firms and companies that are using really the cutting edge of AI and machine learning with respect to investment management are really the large hedge funds and the large systematic macro investment managers out there. So what we're doing is a lot more similar to what they're doing than it is to the standard chatbot approach. We're using a combination artificial intelligence and machine learning tools and techniques to better distill the signal from the noise with respect to generating investment signals and building portfolios. So we use AI throughout the investment management process in a way that's much more consistent with the way the world's largest hedge funds use it than with the way that, a Salesforce or systematic chatbot kind of approach. So it's much less the common thing now, like, which is the large language model and the retrieval augmented generation stuff. And it's much more trying to use a set of tools that allows us to ingest a much greater and deeper set of data. And then from that data, infer more meaningful and better predictive signals from that data about what that means for financial markets and the macroeconomy for portfolios as a whole, to help us make better predictions, make more reliable predictions, make more timely predictions, and then from those predictions, construct more robust portfolios.
That's a great answer, I would say, AJ, because, sometimes people ask me these things because we develop custom models. Depends on what functionality we wanted to add. When you use large LLM models and ChatGPT or any other LLM models, because there are many LLM models out there, people ask, why would you need to customize? Because that when you work with individual companies, when you sorting out data and when you do specifically to tailor a methodology to produce good results, you have to do customization. Otherwise, as you mentioned that, okay, you can use ChatGPT or large LLM models, but those models are not tailored or trained to your specific purposes. And then, the prediction will not be significant like the way you want it to be. So thank you very much for adding this to the network. So my next question to you, what makes your approach unique, helping your clients?
That's a great question because it really allows me to kind of go back and hammer on, the AI and the machine learning components of what it is that we do again. And, when you look at any other commonly available portfolio management or wealth management solution out there, they're generally building portfolios in a very similar way, regardless of where you go or what firm you talk to or what advisor you use or what robo advisor you decide is best for you. And that way is at a very high level, they look at some combination of 10-year forward capital market assumptions, and they build those using similar processes. So whether you go to BlackRock or State Street or Vanguard or any of the major banks, they all have 10-year forward capital market assumptions where they say something like, all right, for large cap equities, we think they're going to return 6% a year for the next 10 years. And for intermediate term treasuries, that's going to be 4.2%. And then they take those assumptions and they build assumptions around correlations between those assets and use those to construct portfolios. And so if you go around and you look at all as an example, an aggressive portfolio, and you look at the one that Goldman Sachs puts together, together and the one that Vanguard puts together and the one that, State Street or Merrill Lynch or Morgan Stanley put together, they're going to be very, very similar in a lot of ways and across a variety of risk factors. And what that results in is similar outcome, no matter where you go and no matter who you talk. What we're doing differently is trying to build an approach that ingests a whole volume macroeconomic, financial, technical, and policy data and use that in a cohesive way to generate portfolios that update in real time in reaction to new data. So when we get new data, it basically kicks off another process in our system that allows our portfolio construction engine, which we call Altitude AI, to build a new portfolio based on the totality of available evidence that we have at our disposal. And what that results in is a portfolio system that changes much more rapidly and much more aggressively than a standard, asset allocation portfolio that you would expect to find, in a 401k plan or with your standard local retirement advisor. And the goal of this is obviously to produce better financial outcomes. So as we've seen in our testing and in our live trading and live investing so far, we start to see some evidence that this is working as intended and delivering value in the way we expect. So we're really excited about that. We think that this is an environment that is tailor-made for an approach like ours, where the macro climate is changing almost on a weekly basis. Things that previously were taken to be givens are no longer given, and the conditions on the ground are changing kind of, as we speak. So what that means for us is really, we're seeing this as an opportunity to prove the value of our methodology. Our portfolios, if you were to go under the hood and look at what's happening in real time, you would see much more conviction behind the signals and ideas that we do have. Our portfolios are not reluctant to make significant changes in fairly short order. So if we see, the signals that we're ingesting that flow into our system see an environment that's poised for an inflection upward in growth, we're going to be getting ahead of that and trying to pack the portfolio with as many growth sensitive assets as possible. If, we're looking out and we see, hey, there's some leading economic indicators that are indicative of heightened percent chance of a recession, and we think that's bad for markets generally, then we're going to be looking to migrate the portfolio away from some of those recession sensitive assets into things that are a little bit more robust and stable, things like short-term treasuries, or actually assets that might have an inverse correlation like gold or commodities in a protective metal sense. So there's a lot of really interesting possibilities out there, and that's really where we spend the bulk of our time, is trying to solve those hard problems for clients.
Thank you very much. It was a great explanation. I have a related question to you. You are in the US, and US lead the way of the future, as everyone knows that. In relation with the new changes with Trump and his policies, how you safeguarding your client or your audience? Like, okay, is this the right time for investment? Because the market is losing value every day. Sometimes they're gaining value, again losing value, because every move Trump's make, the market is affected for that. How are you managing that?
That's a fantastic question, because that really strikes at the heart of why our solution, I think, is so necessary in this environment. And you're absolutely right. When markets are as volatile as they are now, it often is not the most optimum time to invest. If you look at academic studies that have analyzed the forward returns versus uncertainty or volatility levels, a lot of times there are short-term declines that follow periods like this where uncertainty is incredibly elevated and markets are selling off. But what happens if you look forward, a year, 3 years, 5 years from now, it becomes increasingly likely that returns are stronger than average over those windows following periods of uncertainty like this. So, what we've been telling clients is, it's not necessarily prudent to take all of your eggs in one basket. And if you have a bunch of cash on the sidelines, don't just throw it into the market now. But it certainly makes sense. And if you look back at the totality of evidence for prior market dislocations and sell-offs and drawdowns, volatility spikes and the like, that if you start, maybe dollar cost averaging into markets at these levels, your chances of having a positive or, above average outcome over a long period of time, 1, 3, 5, 10 years becomes much more meaningfully attractive in that sense. So compared to where we were maybe, 4 months ago, 5 months ago, it's actually, I think, a better time to invest, all else equal.
That's a great explanation, AJ, because most of the time when it comes for the investment, people think about, okay, is it the right time? What is happening in the world? The war and all those things end up on our mind space. Like, okay, what should we do? The way you demonstrated, like, okay, the way the AI can predict where the market will go, and the historic data and the future prediction, combining both together, it can be really game changer for the clients that you wanted to serve. So thank you very much for adding that. My next question to you. Are partnership part of your business model? And from your partner perspective, what benefits make you an ideal collaborator?
We're always on the lookout for potential partners. And I would say our core mission, our ability to affect change in individual investor portfolios and drive better financial outcomes, it really sets the parameters for what would define for us to be an effective partner. So to the extent that, we're offering value in that way to someone and someone, is out there kind of on the same ideological perspective and mission set of trying to improve outcomes for people, I think there's a lot of potential overlap here. And, for me personally, some of the best ideas can come from collaboration, cross-pollination of different disciplines and different perspectives. So that said, I think there's an ocean of opportunity for partnerships for us. The financial industry is unique in that regard. I think that it really touches a little bit of every other industry. So, there's I think a wealth of opportunity out there to set and define some really successful partnerships for us. And we've had a lot of inbound interest as well in that regard. But, it's as those things take time to set up and do right.
I totally agree with you, because we know that 2 brains is better than 1. 3 brains is far better than 2. So, sometimes people have that itchiness. Like if you are in similar business, you can do partnership, but they forgot these things. That doesn't matter whether it's a similar business, same trade, or a different trade. Partnership can change the game differently, because when 2 brains is together, you can convert more people, okay, and be more successful. So thank you very much, AJ, and thank you everyone for joining today's Innovator Circle podcast. To all of you, thank you for watching today's episode. I'm Dr. 𝐏𝐫𝐞𝐦𝐢𝐞, and I have AJ Giannone, FCA Chief Investment Officer, Allio Capital. For now, we are taking a brief break before diving into some fantastic insights. Stay tuned. We'll be right back.
Great conversations start with thought-provoking ideas, and a visionary leaders turn them into reality. Meet Dr. 𝐏𝐫𝐞𝐦𝐢𝐞, an entrepreneur, AI strategist, and business growth partner dedicated to helping professionals and companies push boundaries, innovate, and thrive to drive transformation.
Did you know that 92% of executives consider digital transformation and AI adaptation are essential for staying competitive in today's market? Furthermore, companies that use data-driven insights for decision-making also see a 23% boost in profitability compared to those that don't. Through ICPcast, we bring together the brightest minds in AI, business, finance, marketing, and other tentative fields to deliver strategies that drive measurable success.
Dr. Shah is the founder and C-level executive and leads multiple startups, including 𝐏𝐫𝐞𝐦𝐢𝐞 marketing agency, Neurodivergent Business Consortium, NBC, Time Research and Innovation, TRI, and Green Threads DPP. He is AI and technology expert and helps businesses harness AI for scalability and efficiency. He is a sales and business growth strategist and the creator of the Sales Funnel Accelerator, SFA program, to guide C-suite executives to maximize conversions and revenue.
You might be surprised to learn innovation isn't just about your ideas. It's about execution. In fact, only 10% of companies successfully turn their innovative ideas into scalable strategies, while the rest struggle with execution. Businesses that focus on effective implementation rather than just ideation 3 times more likely to outperform their competitors. After working with industry leaders and disruptors, I have learned one thing: success isn't just about what you know, it's about how you apply it. That's why I created Sales Funnel Accelerator and ICPcast to provide actionable insights that you can apply right way to drive business growth and innovation.
Podcasting is now one of the most powerful tools for business influence, with 80% of listeners taking action after hearing expert insights. And when it comes to driving sales, 78% of social sellers outperform peers who don't use social media for business networking.
Are you ready to be the part of the conversation that is shaping the future of business? Let's explore innovation, strategy, and leadership together. Book your cast with me today. Hello, everyone. Welcome back to ICPcast. I'm Dr. Shah Siddiqui, and I have AJ Giannone, CFA, Chief Administrator of Allio Capital. We have got some exciting insight coming up. So stay with us as we dive deeper into the world of finance, technology, and innovation. Let's get started. So thank you, AJ, for your contribution today. My next question, could you share your insight on upcoming industry trend and how you are adapting to remain ahead?
It's really interesting that you say this now because the investment industry for a long time has really been, I think, behind the curve a little bit when it comes to adopting new technologies and really leveraging some of these more modern tools and solutions that, maybe the tech industry or, the telecom industry have already adopted and really leveraged to their benefit. So, for me, I think it's really a question of looking outside finance and investment for inspiration. And they make it, frankly, the rest of the industry makes it really easy because they've become so accustomed to just, winning through size or momentum, and really the gravitational pull that some of these large financial institutions have on attracting wealth and capital makes it really, I guess the right term would be they're reluctant to change their approach because their historical approach has worked so well for them. And they feel that, hey, maybe shaking the apple cart, not necessarily in the best interest of their shareholders or their clients. But what that does is present us with some really compelling opportunities to take these institutional tools, these new technologies and systems, and leverage them to drive better outcomes for investors that I think investors will really notice and appreciate. And that's really the core of the mission. So things like deploying our Altitude AI system, which encompasses a bunch of different really slick machine learning and artificial intelligence modules and signal creation mechanisms inside of there to build better portfolios, using some of the more cloud-centric service providers and third parties to ensure that we have best-in-class uptime and performance responsiveness across the app and the investor experience. And really all of that kind of together, I think, feeds into an ethos that we have here internally, that there are better ways to do the things that have been done in the investment industry. And our approach and our philosophy is really to find and identify the best ways to do those things, starting from a first principles approach. What's the objective? What's the best tool for the job? Is it out there? Okay, let's go get it. And if it's not out there, can we build it ourselves and use it to our advantage and put together a really compelling client experience for people to where they, enjoy checking their investment account and don't really dread it, regardless of market environment.
Thank you. My next question, can you discuss a major obstacle you have overcome and lessons you have applied to your professional approach?
It's really a constant struggle in the investment industry. There's never a time where, as a professional in this space, as a portfolio manager, as a chief investment officer, you ever really feel like you've mastered the craft or that, your portfolio is perfectly positioned or you've really optimized everything to the extent that you think you could. So at every discrete moment in time throughout my professional career, there have been a multitude of areas where, I thought that there was room for improvement. But when you look back across that entire time frame that I, constitute as my career and all the different firms and the folks that I've worked with and the market regimes that I've navigated and the, both the bull and the bear markets, one consistent theme that really jumps out is the combination of applying quantitative tools and human experiential insights to arrive at better investment decisions. So, there are firms that take an entirely systematic approach where every investment decision is effectively generated, created, and implemented by a computer. And then there are firms that take a discretionary approach where, it's really just, maybe they're looking at research reports or their computers are generating ideas, but it's really a human that's making the ultimate investment decisions. And I think, like in most areas, the best outcomes are driven by the right mix of those things. So it's really critical that you take a critical lens to your own approach as a practitioner and as an investor and determine, what is the best way to generate the most reliable outcome generation process. So, at every point in the market cycle, you can have an opinion as an investor. The computer can have an opinion, as a systematic tool. And how do you blend those two opinions together in a way that consistently is more likely to add the most value for clients? And that's really the part that excites me is how do you, what's the right mix there? Is it a static mix or does it change based on market conditions? In an environment like the COVID crash of 2020, that was an environment where a lot of systematic managers managers ended up on the wrong side of the trade because their models hadn't been trained on data that encompassed a worldwide global pandemic and the market reaction, that follows something like that. So, models that would otherwise have generated returns in every other market environment failed to anticipate or react to that particular shock, in a way that was consistent with what was happening. And an example of that, we talked with some managers who their models effectively said something along the lines of, when volatility spikes or when there's, risk that's pervasive or when sentiment deteriorates, we want to go to like recession haven stocks. So things like Clorox or things like Procter and Gamble or, Kraft Heinz, which are traditionally defensive stocks. But those were precisely the products that had the supply chain issues. And it was the digital tech firms that actually outperformed, during the COVID crisis. So, the systematic approach has a lot of value. And that's really, I think, something that's inescapable and quite obvious at this point in time is that, there is an element of the systematic approach that you really need to leverage if you want to be successful in this business. But you also have to have that human insight, that human overlay to determine, hey, are the signals that are coming out of this systematic and quantitative system making sense intuitively, given what we see, as conditions on the ground? And if not, can we step in and say, hey, this doesn't make sense. There's a better way here.
Thank you, AJ. So my next question is, how do you measure your success, both in your business and for client you serve?
It's really a two-pronged answer. And at the end of the day, like any business, we're trying to solve a problem for people. And the problem that we're trying to solve always comes back to, we don't think that investors are being adequately served with quality financial solutions that enable them to build the financial future that they want. So, our kind of guiding light, our North Star is, are the Allio Capital investment strategies adding value for clients? And depending on what the particular mandate of that strategy is, whether it's capital preservation or aggressive growth, or, maybe an uncorrelated absolute return strategy, are those strategies doing what they're designed to do? And are they benefiting investors in the way that they're designed to benefit investors? So that's, first and foremost, that's one of them. And then the second piece is, are the investors, are our investors and our partners in that way, are they deeply, deeply satisfied with the experience that we're giving them? We do offer the investment strategies, but we also offer a whole host of other, little tools and apps that help them really build a comprehensive view of their own wealth and to make more informed, wealth and investment decisions. So, there's the investment strategy piece of it that we really want to make sure that we knock out of the park, but there's also the rest of it. It's the cohesive, user client experience, so to speak, where, we have our net worth tracker feature, we have our macro dashboard that lets folks, really track and stay on top of what's happening in the macro economy, gives them a comfort level with, hey, I'm seeing things change. I'm able to anticipate, turning points and catalysts here. And really it's that totality of information that we're attempting to provide and curate for folks in a way that makes them feel comfortable, makes them feel like, they have control of their financial future and they're not just exposed to the ebbs and flows of the macro tide, so to speak.
Thank you, AJ. So my next question, what skills or traits do you think have been most important to your success as an innovator?
That's a really interesting one as well. And I want to go back to when we were talking about the partnerships. And I think the most impactful thing has been my ability to really listen to different disciplines and different areas of different organizations and use those different perspectives to come up with creative new solutions to older problems. So, everything that exists here at Allio has already, for the most part, existed somewhere else. But, we're taking some of the, more modern and cutting edge approaches that are being used in the world's most successful hedge funds, and we're using them in our investment strategies. And we're taking, some of the more cutting edge onboarding and client experience tools and apps that are out there, and we're layering them into our client experience. So I think one of the things that I've really tried to strive to do here, and one of the things that gets me, excited to get out of bed every morning and get to work, building this next generation wealth firm, is that I think that you can really deliver a lot of value for people by simply just taking a step back and listening to the different constituents, in your teams and in your companies and in your firms who maybe are a little bit more quiet, maybe aren't as outspoken, but have really good ideas and really valuable insights from their set of experiences and try to layer them together, into a tapestry of effectiveness where you're, taking the best bits of every person's experience and using that to build up something that is, you get a little extra juice than it would all add up to otherwise, so to speak.
Thank you very much, AJ. We are having a nice conversation, and I think viewers will love when they will watch this podcast. So thank you everyone for joining today's Innovator Circle podcast. I'm Dr. 𝐏𝐫𝐞𝐦𝐢 and I have AJ Giannone, and we're going to be talking more. I just have last questions, but after that is the fun part. Just making some fun while we're talking. So my last question, are there any misconceptions about your industry that you like to address and clarify here to the viewers?
Definitely. And I'm glad you asked this. The one thing that I always get asked as an investor and as an investment professional, is what stock should I buy? And, oh, what's a great stock to buy right now? And that's 100% the wrong approach in my view when you are just starting out on an investment journey, or whether you're a seasoned investment professional. The lion's share of any particular investor's return over a long period of time comes predominantly from their asset allocation. And Vanguard has done some phenomenal studies that support this assertion, but approximately 90% of an investor's long-term return is attributable to their asset allocation, first and foremost. From there, you can drill down and say, okay, maybe the next 7 to 8%, their return is attributable to, things like asset, like geography or sector or industry or whatever subcategory you want to layer into that asset allocation. And then from there, there's a tiny sliver of your return that is then attributable to single stock performance. And even more than that, when you're taking a big bet on a single stock, you absolutely have that chance of an outsized win, but you, even more than that, have a chance of a far greater chance of an outsized loss. And there's another great set of studies that are floating around out there that attribute something like, I think, 95% to 100% of the total return, a large cap index like the S&P 500 over the last 100 years, to something like the top, whatever it is, 5% of stocks, or even fewer than that. So, when you're picking a stock, off of a screener or from a tip from a friend, there is a very significant likelihood that that stock will underperform the broad market by a meaningful amount over any small, medium, or long-term sample size. So what, we tell people, and what I tell everyone who asks me that question, oh, what's a great stock to own, is it's the wrong question to ask. I might have an opinion about what stock could outperform over the medium or long term, but at the end of the day, the first place to start is, what's the appropriate asset allocation for my investment time horizon and my risk tolerance, and then consequently, like once you get that right, the rest of it just kind of falls into place. You figure out, okay, I want to maybe overweight technology and underweight utilities because I want to be a little bit more aggressive, or I think that there's a likelihood that technology is going to have better returns on average than utilities, and on a risk adjusted basis. But I'm certainly not recommending individual stocks as huge allocations for an investor's portfolio. I think like anyone else, there's people who derive some sort of entertainment utility from trying to effectively pick lottery ticket winners and saying, oh yeah, I want to buy GameStop or Robinhood or whatever, and try to 10x my money on that. But at a minimum, in that scenario, it's incumbent upon you as an investor to understand you are making a negative present value bet and to size that position accordingly. Position sizing is crucial when dealing with high variance, low expected value bets.
Thank you, AJ. So now we're going to be starting the fun part. We are nearly finishing our podcast. So these segments, we ask different questions. Let's just to make some fun. If I ask you the best food you wanted to eat that is not, you cannot get it in the US, do you travel somewhere else?
I hate to be cliche, but to go back to my roots, I got the Italian last name. I loved the food. I went to Italy, maybe 10 years ago and loved the food there. The ability to just kind of eat pasta and drink wine at every meal every day. I thought I would get tired of it and I never did. So I'd love to be able to, find a way to make that happen with some more regularity. But yeah, I'd probably pack on another 20 or 30 pounds after a period there, but it would be a fun exercise for sure.
Do you know that on Italian spaghetti, there is a thing that you don't break your spaghetti? How do you cook your spaghetti?
I used to break it, and then after I saw that, I think I saw a video or YouTube video or something where there was an old Italian guy showing people how to cook. He's like, yeah, you never break it. I'm like, oh, I'm sorry, ancestors. I failed you, but no, that's it. It's you got to salt it. You got to just leave it unbroken, and the sauce is another big thing too. I now have a much greater appreciation for making my own sauce. And I got to confess, my wife does most of the cooking, but I when it comes to the sauce and the Italian stuff, I take a much greater interest.
That's a great thing. I did not have any Italian guests before, so we're just learning. So next thing, can you speak in Italy?
No, I can't speak a lick of Italian, and it's funny because when I went took a trip to Italy, like I said, maybe 10 years ago, I'm going through the airport security, and they see your passport and they ask you to say your name, and I say, oh, I'm AJ Giannone, and the woman looks at me and like it is, you can see the disappointment in her face, and she's, oh, Giannone, that's not how you say it, Giannone, like
Okay.
she's telling me how to say my own name. I'm like, I'm sorry, I'm from America, I don't know what to tell you. This is how my grandparents said it. That's as much as I have. Oh yeah, no, she just like shooed me away. She's like, get out of here. This is this guy just doesn't know how to say his own name in Italy. But I thought that was funny. I was disrespecting their language or something. But what are you gonna do? Do the best you can.
That's the thing, because I'm from Bangladesh. I have an accent. I cannot improve that. I'm living in the UK more than 21 years, 22 years now. My son, he born here, and his accent and his way of thinking is different than I did. So particularly, my third generation would be more different. So that's the normal norm, isn't it? The way you brought up in certain areas, when you come to relocate to a different places, it's going to be different. You cannot change your route anyway. So thank you for adding this value to this podcast. I just wanted to ask you, do you have any takeaways for our guests, for our viewers?
Absolutely. I mean, at the end of the day, the most important thing for people is to take an interest in these things. You don't have to be an expert portfolio manager. You don't have to be, a stock picking guru or any of these things, but it really is essential in today's world that you don't let your investments and your finances kind of just sit to the side and not get the attention, that they deserve. You need to really tend them as you would a garden or really any hobby, even if it's not, the most interesting thing in the world to you. Finding a trusted partner as a solution is equally valid as doing the work yourself. Like I said, in the same way that, maybe you do your taxes or, you have, someone handle other, professional services for you. There's a opportunity cost associated with leaving your finances unattended. And that really compounds over time. And that's the beauty of this business and the investment industry in particular, is that your successes and your failures are compounded through time. So even small decisions that you take today can have incredibly meaningful outcomes for you far in the future. So if you have, 20, 30, even 10 or 15 years to go until retirement, or, until you plan to, be done with your working career, there's still time to add value to your portfolio, to give your future self, a better chance at success than would be the case otherwise. And really that's what we're about here at Allio, is finding ways to kind of cut through the noise and give people, better solutions that help them reach their goals. And, knowing that it's one of those things that a lot of people just don't have any interest in paying attention to, but we firmly believe it's extra critical right now just because of the environment. A lot of the assumptions that people have relied on, in the past are kind of changing. The sands are shifting beneath our feet. The geopolitics of it all, the macro, the fiscal policies, all the politics, like it's just not certain that the next 50 years are going to look like the last 50 years. So at minimum, I think it is incumbent upon people to pay attention and to take an interest in this, because it really is so critical. But, at the end of the day, nothing's certain, but paying attention gives you a better chance of success than burying your head in the sand.
Thank you, AJ. So thank you, everyone, for tuning to the Innovator Circle podcast. I hope that today's conversation with AJ has sparked some fresh ideas and provided valuable insight to elevate your business strategies, whether it is in sales, marketing, finance, or innovation. Don't forget to subscribe to our newsletter at icpcast.com. Share this episode with your network. Leave a review. It helps us reach and inspire more leaders like AJ. And like our page on LinkedIn, subscribe to our YouTube channel. Sales Funnel Accelerator, and behind the scenes and content and updates on upcoming episodes. Until next time, stay inspired, stay curious, and keep leading the way in innovation. Thank you, AJ, and thank you, everyone. Bye-bye.